Hello and welcome to Accounts Payables video. In this session, we'll see how it impacts the three financial statements. Just to recap from our last video, we worked around how accounts receivable impacts all three financial statements, and yes, we can see the drastic change between the numbers. We can, just to make it a bit realistic, we can make it a change in assumption. Yes, moving on to accounts payable. Accounts payable is a liability. The reason we are supposed to pay to our suppliers, to our partners, to our employees, and that's where it comes into the picture. An increase in accounts payables will lead to increase in our cash. Thus, it indicates that either the company is paying off its suppliers or paying off its employees will circulate around the impact on the financial position. Let's say 200 of payables we are supposed to pay to our employees. So I'll just hardcode this number. This 200, similar to accounts receivable, will be part of our income statement. However, when we will be paying to our employees, only balance sheet and cash flow line items will get impacted. Please note that I have used a minus sign over here as it is an expense, and since it is adding back to our income statement, I'll have to add it back and change in minus sign. Here I have added plus 150. So yes, during the year, in between 200 were the payables. So by the year, in between months or quarters, while we are accounting for this, we need to make sure that we are adding this back. Now, accounts payables are a liability. So when liability goes up, cash goes up. So from a reverse way, from accounts receivables, what we did was we deducted T0 and T1. Here we'll be doing the reverse accounting entry of T1 minus T0 because of the nature of the expense. I request you not to ratify plus minus of the numbers, but to understand the concept. The reason cash goes up, liabilities goes up. Accounts receivable is an asset, it went up, cash went down. That's why the signage works. Please note this is beyond debits and credits, and here the importance of signs matters the most. Okay, so yes, we have factored in our payables at 200. Our accounts payable in cash flow is added back. Overall, our cash from operations is 353. Please note there is an additional impact of 353 because of payables. It was 303 and now it is 353. An increase net because of plus and minus sign. Overall, I have already added the changes from the three financial activities. We'll be evolving around financing and investing activities soon. The cash beginning is added back from the beginning balance and ending is linked just like in the previous video. Now currently, as we see, our balance sheet is not matching. That is mainly because of the formula issue. Here it is only 100. I have added liabilities and equity. I'll add back the payables as well, and that's how balance sheet balances. Question comes on how it impacts numbers when the payables are being paid. So let's say we pay back the salaries to our employees. This 200 that we have kept will remain as it is, so we'll be hard coding it, and any gain of changes in number will happen between the balance sheet and cash flows. So let's say if we are paying 150 back, so as you see, to the extent cash went down and payables are in the same range. One quick way to understand overall the linking is you see income statement, you see balance sheet, and you see cash flow. Increase in expenses leads to increase in EBIT and post-tax PAT. That PAT is linked with equity. Also, it's the beginning of net income. Just like the golden rules of accounting, there are two impacts. There will always be another impact between balance sheet and cash flows, one being in income statement. Please note, we need to also observe the signs. Since payables has decreased, that means salaries are being paid on time, a positive sign for the company. Thank you for watching. Stay tuned for the next video.